Turn on any cable news network, and you're hit with a wall of loud opinions and punditry. But there is a quieter alternative: markets, where people are backing their convictions with actual money. When there's a financial cost to being wrong, the noise drops away, and a very different picture of the future emerges. Platforms like Kalshi and Polymarket facilitate this by allowing users to buy shares in the outcome of future events. If the event happens, the contract pays out $1. If not, it goes to zero. The price you see is essentially the market's collective estimate of an event's probability. Keeping track of these disparate exchanges is what PixByOdds does. It's a daily dashboard that aggregates market sentiment from across the web. They don't take bets themselves, they just provide a live read on where the money is moving. This dashboard centralizes 291 active markets, cross-referencing 150 contracts on Kalshi with 141 on Polymarket to track price differences in real time. This influx of crowdsourced data offers a sharp look at global events, but it can also be a trap. Without a clear framework for how to read these numbers, the data is just as likely to confuse you as it is to inform you. The difficulty lies in the sheer volatility. Obscure geopolitical events that never make the evening news can experience sudden, drastic price swings overnight on these exchanges. Consider this market regarding a potential U.S. blockade of the Strait of Hormuz. In a single day, the probability of an announcement about the blockade being lifted shifted by 73 percentage points, backed by nearly $1 million in trading volume. That kind of volatility forces a choice. You have to decide if you are using this information to understand global events, or if you are trying to make money from it. We can generally categorize the users who visit this dashboard into 3 groups based on their goals: the news junkie seeking raw sentiment, the casual speculator looking for a payout, and the arbitrage trader hunting for price discrepancies. To get any value out of the PixByOdds digest, we need to match the specific data modules on the site to those 3 specific approaches. Data without a strategy is just noise. If you apply the wrong framework to this board, you're essentially ensuring you'll either waste your time or lose your capital. Let's start with our comparison matrix and look at the first major data feed, the volume leaders. This tracks where the most money is currently being spent. High-volume anomalies connect as an early warning radar. When millions of dollars suddenly flow into a specific contract, it often indicates a shift in sentiment before mainstream news outlets have even finished their first draft. However, following volume blindly introduces a risk: meme volume. When a niche, passionate internet community rallies around an outcome, their collective betting can distort the probability lines. If you see a contract at 80%, it might just be reflecting the enthusiasm of a specific group, rather than a realistic likelihood, which can be a trap for casual bettors. This is why you cross-reference that volume with the biggest movers list. Tracking price changes over time helps you separate the social media hype from actual momentum-driven news events. For a news junkie, volume anomalies are an effective sentiment filter. But for a speculator, they are a danger if you mistake crowd enthusiasm for a guaranteed outcome. Next, we have the most technical section of the digest: cross-venue arbitrage pairs. Arbitrage exploits the price differences for the exact same event between different platforms, specifically Kalshi and Polymarket. Sometimes these gaps are wide. On a May 5th Bitcoin price range contract, Kalshi priced the outcome at 1 cent, while Polymarket priced it at 98 cents, a massive 97.9-point spread for the same event. Mathematically, this offers a clear promise. By buying the low-priced contract on one site and the higher one on the other, you could theoretically lock in a risk-free profit, regardless of where Bitcoin's price actually goes. But that profit is often smaller than it looks. Platform fees, withdrawal costs, and the time it takes to move capital between these sites can quickly erode your margins. Furthermore, algorithmic bots are designed to spot and close these gaps instantly. By the time a human trader manually executes the clicks, the spread is usually gone. Arbitrage is a real phenomenon, but capturing it requires the speed and infrastructure of a professional trading desk, not a casual reader. The third data feed focuses on quantitative edges, specifically in weather markets and the long-shot watch list. Weather contracts are tied to verifiable data like daily temperatures in major cities. Traders look for an edge by comparing the market price to raw data from official known models. The goal is to spot instances where the crowd's emotional betting doesn't align with the meteorological science. If a model suggests a 60% chance of a specific temperature, but the market only prices it at 40%, a statistical edge exists. The long-shot watch works on a similar principle. It flags markets price under 10 cents that are seeing real volume, indicating a potential for a high payoff if the market has mispriced the risk. The main constraint here is time. These markets are efficient. They correct themselves the moment new information breaks. These data points offer genuine setups, but the edge is fleeting. Reading a 6 a.m. digest at noon usually means the opportunity has already passed. To decide how you should use the picks by odds data tomorrow, you have to map your goals to the right tools. We can use an effort versus ROI framework to map your approach. The news junkie gets high informational return for low effort. The casual speculator bets blindly, high risk, low effort, a trap. But the edge trader sits in the high effort, high ROI zone, requiring true dedication. The platform reports the market activity exactly as it happens. You only lose if you mistake that raw data for a simple casual tip. Entering niche markets like weather or obscure politics without a proprietary model puts you at a disadvantage against professionals who are processing variables much faster than you can. News moves faster than human reaction time. A single Donald Trump announcement can swing political contract odds by 70 points in minutes. If you are trading without an analytical edge, you aren't really an investor. You are just providing the liquidity that the professionals profit from. Your most effective strategy is to use the daily digest as a read on global sentiment and only execute trades if you are prepared to treat it like a professional discipline. Prediction markets replace the traditional pundit with a financial scoreboard. Knowing which game you're actually playing is the only way to survive.